Welcome to this explainer. We're going to dive straight into the extreme contradictions of the 2026 financial landscape and really separate the dangerous market noise from the actual undeniable signal. Right now, the financial world is literally flashing mixed signals everywhere, and honestly, knowing how to read the dashboard is the difference between getting caught in a massive trap and perfectly positioning yourself for the future of finance.
So let's kick things off with a pretty crucial question. When you look at the current market, are you following for historic traps driven by hype, or are you tracking the quiet, massive shifts of institutional money? You know, it's incredibly easy to get distracted by flashy headlines and sky-high valuations. But as we'll see today, the real money is moving behind the scenes, fundamentally rewriting how global assets are traded, settled, and stored.
Section 1. Decoding Mixed Market Signals.
To figure out where the market is actually going, we first need to look at the extreme contradictions flashing right in front of us. Despite some really high global uncertainty, traditional markets are showing this strangely aggressive risk-on behavior. The top 10 U.S. companies are dominating with a historically extreme $25.3 trillion in combined market value. I mean, to put that into perspective, that's larger than China's entire GDP. It represents around 80% of the U.S. GDP. It's a remarkably top-heavy market, mostly driven by the AI boom, which leaves a lot of investors totally exposed if they don't understand exactly why the indices are rising in the first place.
And this dynamic brilliantly hits the nail on the head regarding the core problem. Retail investors are out there emotionally chasing expensive assets at the absolute top, while smart money, the serious investors, are quietly looking at discounted, boring markets. It's classic retail psychology, right? People rush to buy when prices are soaring and completely ignore the market when assets are actually sitting at a discount. Serious investors do the exact opposite. They build their positions through gradual accumulation when things are quiet.
Section 2. The SpaceX Valuation Trap.
Now, what's really fascinating is how this retail emotion sets the perfect stage for the ultimate hype trap, the upcoming SpaceX IPO. It's basically the perfect storm of a massive global brand, intense media focus, and pure FOMO. While SpaceX is undeniably a world-class company, its demanding $1.75 trillion valuation means this historic event could easily become a huge liquidity trap for the ordinary buyer. To justify a number that massive, literally everything has to go perfectly right at exactly the same time. The first phase of this IPO is likely going to heavily favor insiders, banks, and early investors, not the everyday retail buyer trying to chase that first public price.
The crucial point here is that investors might think they're just buying a space infrastructure leader, but they're actually funding an incredibly expensive AI operation that burns through billions. SpaceX is really three distinct businesses rolled into one. You've got rocket launches, which show clear global dominance. Then there's Starlink, the most profitable part, but actually, the average revenue per user is falling. And XAI, that is a massive cash-intensive experiment. When you buy in at $1.75 trillion, you're placing a huge bet that Elon Musk's AI venture succeeds flawlessly right alongside those rockets.
And we definitely can't ignore the mechanical danger here, the index inclusion trap. If SpaceX enters major global indices, passive funds and ETFs are literally forced to automatically buy the stock. That creates a really powerful short-term demand wave. But if you buy into that initial emotional spike created by forced index buying, you might be left holding the bag when that synthetic demand suddenly fades. The real opportunity for serious investors is to wait out the initial hype and see how the stock performs once the lockup periods end and the market structure actually settles down.
Section 3. Retail Hype and Crypto Lows.
You know, this dangerous tendency to chase hype isn't just a stock market thing. It's bleeding directly into the crypto markets too, where retail attention is heavily misplaced right now. The exact same psychological traps catching traditional equity investors are playing out on the blockchain. With altcoins in a critical red zone and major assets like Ethereum losing retail attention, bored capital is just chasing short-term, low-quality meme pumps. When the broader market gets quiet and volatility drops, retail money flocks to whatever is moving. We saw massive retail attention on Ethereum when it was super expensive, but now that it's cheaper, that attention has totally vanished. Instead, they've jumped straight into the trenches.
But guess what? The hype doesn't last. Activity on attention markets like pump fund has completely crashed by 80% over just 3 months. That proves pure speculation just isn't durable. Sure, these short-term pump and dump plays can produce massive, quick gains, but they collapse just as fast. Meme coin launchpads have to mature and build transparent, durable incentives, or they're just going to burn out their users entirely.
And even the heavyweights are struggling for real footing right now.
Bitcoin's recent price bounce actually lacks strong fundamentals. It's acting more like a paper-based rise, caught right between strong supply pressure at $68,000 and demand at $63,000. Capital flows into Bitcoin and stablecoins have actually been negative, so the bounce isn't supported by strong institutional inflows yet. It's very much a waiting game.
Section 4. Crypto Institutional Infrastructure Shift.
Okay, so here is where we find the real signal. While retail is completely distracted by falling prices and meme dumps, smart money is quietly overhauling the entire plumbing of global finance. This is where the long-term compounding value is actually being built. The market is maturing, shifting away from those old offshore contract risks directly into CFTC-regulated perpetual futures onshore with Kraken. Bringing one of crypto's most dominant derivatives products into a regulated domestic venue is a massive step. It clearly shows the institutional capital demands transparent, legally compliant market structures before they even think about deploying heavy volume.
Over in Europe, the new MiCA regulatory framework is turning compliance into a literal survival test. Regulation now decides who gets to stay on the map and who simply disappears. As that July 1, 2026 transition deadline gets closer, roughly 75% of pre-registered firms are at risk of losing their status. Compliance is no longer just a legal headline. It has become hard infrastructure. Companies like BitGo are literally offering crypto as a service just to help other firms survive this regulatory purge.
And it's not just exchanges. Even corporate crypto treasuries are facing brutal accountability. It proves that simply holding Bitcoin isn't enough when you face real capital structure and dividend pressure. We're actually seeing preferred stock from major digital treasury firms trading well below par due to dividend coverage and competition concerns. The market is essentially saying, we don't just care how many coins you hold, we're judging you like a traditional credit product with real debt and cash flow responsibilities.
Section 5. When AI meets Wall Street.
This regulated, heavily structured base layer we just talked about is absolutely crucial as we enter the era where Wall Street tokenization collides with artificial intelligence. Crypto is no longer just about trading venues, it's rapidly becoming the operating system for legacy finance. Coinbase, for example, is pushing hard to become a full financial operating system with tokenized U.S. equities. But this raises a massive new question. Do you own the voting rights, the dividends, or just a synthetic tracker? As real-world assets move on-chain, the defining conversation isn't about whether we can tokenize a stock anymore. It's all about custody, redemption, and legal jurisdiction. Investors need to know exactly what legal rights are attached to that digital token.
The traditional finance toolkit is arriving in full force, and it's brilliantly illustrated by BlackRock slicing Bitcoin into structured covered call income products. With the launch of their Beta ETF, they're literally turning Bitcoin volatility into a premium income stream. This proves that institutions aren't just buying spot Bitcoin, they are wrapping it, slicing it, and structuring it into complex portfolio tools for traditional wealth management.
And the backbone of all of this? Stablecoins. They've totally shifted from being mere trading pairs into actual global settlement rails. Just look at Ripple's cross-border push into Africa. With compliant B2B payment corridors and state-level money market funds getting involved, stablecoins are now entirely about reserve quality and payment utility. They're moving real value across borders with just a fraction of the friction of legacy banking.
Plus, as AI agents actually begin executing trades on these networks, the hardware demands are just staggering. Pivoting miners are facing a $50 billion funding gap just to survive the transition. We're moving away from fluffy AI narratives to actual mechanism design. If autonomous AI agents are going to manage on-chain finance, they need robust, safe execution layers. And the physical data centers supporting this transition, they require an immense amount of capital.
Finally, Section 6, Finding the Real Signal.
All right, let's tie this whole thing together so you know exactly what to take away from this explainer. We've looked at the extremes of traditional markets, the IPO traps, and the quiet building of actual infrastructure. The noise is the emotional FOMO over a $1.75 trillion IPO and the short-term meme coin pumps. But the true signal? It's the relentless institutionalization of financial infrastructure. Regulated onshore derivatives, tokenized equities with totally clear property rights, stablecoin payment rails, and robust treasury frameworks, these are the foundations that are going to compound value over the next decade.
So as you navigate this incredibly complex market, you really have to ask yourself a critical question. Are your investments funding fleeting, overvalued experiments, or are you actually holding a piece of the new, regulated financial operating system? The tools have absolutely arrived. How you choose to use them will define your portfolio for years to come. Thanks for joining me on this explainer, and I'll catch you next time.